initially, we'll have a look at the private equity market overall. As you can see, in terms of assets under management, since 2000, the industry has grown quite regularly, quite consistently. Obviously, to some extent, driven by the strong performance of some of the primary private equity funds. So the investors, the LPs, really like private capital right now. Comparing it with the public market, as you can see, also the private equity market, whilst in the 80s when I started in the industry, the private equity market was very much a cottage industry, a niche industry. Those days are long gone. If anything, in the last 15 years, we've seen private equity market grow significantly faster than the public equity market. So detaching from, from the public equity side. I'd like to have a quick look at the drivers and the growth of the secondary market now. So secondary market is the resale market for investors' interests in the funds and as well in secondary, in direct investments. So the secondary transactions are one way for LPs to exit early from their investments if they were invested in any of the primary funds. The market has very much grown in line with the primary market. So why? Because it obviously allows investors to achieve liquidity early, rebalance portfolios, modify exposures due to regulatory changes, as we saw it post the last global financial crisis, and also lock in returns on their private equity investments if and when they would like to do so. The next picture just shows a little bit, again, the growth on the primary private equity fund side versus the secondary fund side as well. Now, before we go to our panel, I wanted to have just a brief conversation on the kind of transactions that we see in the secondary space. Traditionally, secondaries were focused very much on LPs. So LPs are the institutional investors in private equity. And those LPs would, if an LP wanted to step out of a primary private equity fund after, let's say, 5 or 6 years, the only way they could achieve that kind of liquidity was through a secondary transaction. Nevertheless, nowadays, secondaries have moved on, and we now see quite a lot of synthetic transactions or direct secondaries, which basically requires the secondary buyer to set up potentially a complete new vehicle and to absorb assets from a first investor into that new vehicle. I will keep it at this level. Anyone has any further questions after this, we will post, of course, the slides online and the recordings, but also you're all very welcome to contact, obviously, Francois and KAtrina on LinkedIn for more questions, or send me a question as well. You're very welcome. So let's go to the next slide. And I added this slide because obviously in the context of the present crisis we are in, people ask regularly, what will the impact be on the private capital space? Traditionally, we don't see impact on pricing until further into a crisis, simply because the adjustment is obviously not as fast as in the public equity market. So I thought I'll share this kind of timeline with you. As you can see, in 2008, 2009, pricing for secondary assets in private equity went on average as low as 50 to 60 cents on the dollar. So obviously we have, in the last few years, we've seen assets actually change hand at way over 100% of NAV, net asset value. But we will have to see, and we can ask later on our panelists how they feel how this crisis will potentially be different from the last crisis. Now, in terms of risk profile for secondaries versus primary funds, we usually get that question, and I thought I'll just put this little picture in here. As you can see, when you look at the IRR of secondaries versus the risk they're taking. So in terms of riskiness, clearly secondaries are in a lower quartile of the private equity space, the private capital space, but clearly have managed to achieve interesting IRRs. That obviously makes them interesting, especially also for first timers or first time LPs to the private equity space. And I thought what would also be interesting, what obviously people, investors are interested in, is what is the portion of funds that have returned a less than 1.0x? What does it mean? What funds, which portion of total private equity funds have returned less than the capital invested, i.e. a loss? And as you can see, venture, no surprise, obviously is by far the most risky asset class, and the largest percentage of venture funds actually does return less than 1x to its investors, about 25 to 30%, whereby secondaries is exactly on the other side of the spectrum.